Welcome to The Deep Dive, your shortcut to being truly well-informed. We cut through the noise of earnings calls and research to give you the essential insights.
That's right. No fluff, just what you need to know.
And today, we're unpacking the first quarter fiscal year 2026 earnings for James Hardie. This call came after market close on August 19th, 2025. And it definitely gave investors a lot to chew on.
It certainly did. Quite a market reaction followed.
Yeah, we'll get to that. We'll be diving into the frankly surprising numbers, management's take on some tough market conditions, and the critical early days of their really big AZEK acquisition.
It was a quarter with some challenging headlines, no doubt, and the market definitely responded.
It sure did. That reaction tells a story in itself, doesn't it? The immediate challenges maybe overshadowing the longer-term strategy they're pushing.
Exactly, that classic tension.
Yeah.
Short-term performance versus the long game.
Absolutely. Okay, so let's get right into the raw numbers first. James Hardie reported GAAP diluted EPS of $0.15. Yeah, and just to put that in perspective, that's a hefty 59% drop year over year.
Wow.
And they're adjusted, the non-GAAP number, that came in at $0.29, which importantly missed the consensus estimates. Analysts were looking for about $0.35.
So a miss on both GAAP and adjusted EPS.
Right. And revenue for the quarter also fell short. It hit $899.9 million. The consensus was closer to $950.7 million.
Okay, so that's a miss of what, over $50 million?
Yeah, over $50 million. Represents a 9% decline from last year.
And what really strikes me there is the hit to profitability. Operating income landed at $138.6 million.
Yeah.
Margins shrank pretty significantly, down 8.3 percentage points year over year to just 15.4%.
Ouch.
Yeah. And an adjusted EBITDA that stood at $225.5 million, with margins down 3.7 percentage points to 25.1%.
So pressure across the board there.
Yeah.
Any regional differences stand out?
Well, North America fiber cement sales were notably down about 12% year over year. Europe, interestingly, managed a 7% increase.
Okay.
Some divergence there, a little bit. But, despite all these pressures, it's worth mentioning their operating cash flow held up reasonably well, $207 million. Capital expenditures were $103 million.
So cash flow is still strong?
Relatively strong, yeah.
Yeah.
But overall, the picture these results painted was, well, a broad miss against what the market was expecting.
And hence the reaction we saw. But let's try and understand why these numbers took such a hit. Management really leaned heavily on this phrase, normalization of channel inventories. What exactly are they talking about there?
Yeah, that was the key theme. Basically, normalization means distributors and retailers, the channel partners, are cutting back on the amount of inventory they hold.
Okay, so destocking. Why now?
Well, think back to the pandemic housing boom. Demand was high, supply chains were messy, so channels tended to overstock just to be safe. Now, growth expectations are moderating. There was uncertainty, especially back in April and May.
Right.
So customers are just being more cautious. They don't want to be caught holding too much inventory if demand slows further.
And this created a challenging environment for demand itself, right? Both R&R and new builds.
Absolutely. Repair and remodel, or R&R, homeowners are apparently deferring those big ticket projects, the major exterior facelifts or siding replacements. That hits James Hardie directly.
And new construction.
Still facing affordability hurdles. Big time. Single-family homes are expensive. Interest rates are still a factor. So builders are moderating their starts. They're aligning their inventory with slower sales traffic.
Makes sense. Did they mention any specific regions being hit harder?
They did. They called out the U.S. South, particularly Florida, Georgia, Texas. These areas are heavily exposed to new construction, so they felt some outsized pressure.
Got it. So volumes down, especially in North America. But here's something interesting. Management said pricing actually went up. North American ASP rose 3% year over year. How does that square?
Yeah, that is interesting, isn't it? It's actually pretty significant. While the overall volume fell, partly due to that destocking, the fact they could still raise prices suggests their product has a strong value proposition.
Brand strength, maybe?
Brand strength, perceived quality.
Yeah.
It implies that the customers who are buying are willing to pay that premium. It also shows management is actively trying to protect margins, even in a slowdown.
Okay.
They also mentioned channel partners are adopting more cautious order patterns, kind of defensive inventory positioning, especially looking into the back half of the calendar year.
So a wait-and-see attitude from customers, expecting maybe more volatility.
Seems like it, yeah.
Okay, so that's the challenging side, but there's a huge counter-narrative here. The AZEK integration. That acquisition closed July 1st, 2025. A massive move, right? Doubles their addressable market, basically.
It's a huge strategic play. Bold, especially given the current market headwinds.
And how's that integration going? It's still very early days.
Very early. But management sounded, well, pretty satisfied with the progress so far. They specifically talk about rapid progress on cost synergies, finding those savings from combining the two companies.
Okay. Any specifics there?
Yeah, they said over 50% of the run rate target for G&A cost savings, that's general and administrative, has already been actioned for this fiscal year. They expect about a $20 million benefit to the P&L.
50% actioned already. That's fast.
It is fast. And they reiterated that the overall $125 million cost synergy target over 3 years is still on track. They even hinted they might be able to exceed it.
Wow. Okay, so they're executing quickly on the cost side. What about the commercial side? Selling more stuff together.
Also seeing early wins there, apparently. They mentioned new multi-year exclusivity deals with big home builders like Beazer Homes, covering both Hardie siding and trim.
Bundling.
Exactly. And dealer partners are committing to AZEK's PVC trim now because it aligns with James Hardie. Contractors are apparently cross-selling TimberTech decking right alongside James Hardie siding.
That makes a lot of sense. One-stop shop for the exterior.
That's the idea. Creates a powerful combined offering. And, the legacy AZK business itself, it actually had a strong June quarter before the deal closed. Their deck, rail, and accessory segment saw mid-single-digit sell-through growth, better than they'd guided for.
So AZK was already performing well.
Seems so. And post-acquisition, James Hardie's CEO, Aaron and the leaders of both legacy businesses met with major customers right away, showing that unified front.
That signals strong collaboration, which is key for a big merger like this.
Absolutely critical.
Okay, let's pivot to the future then. What's management guiding for the rest of FY26, now including AZK?
Right. The updated guidance incorporates AZK from July 1st. Total adjusted EBITDA is projected between $1.05 billion and $1.15 billion. That range includes about $250 to $265 million expected from AZK.
Okay. And for the core siding and trim?
Net sales guided between $2.675 and $2.85 billion. Importantly, that assumes a high single-digit market demand decline for the full fiscal year.
So they're baking in that continued softness.
They are. For the new AZEK segment, deck rail accessories, they're forecasting $775 to $800 million in net sales for the remaining 9 months.
Got it. What about cash flow and EPS?
Free cash flow expected to be at least $200 million. CapEx, around $400 million total, with $75 million of that for AZEK over the 3 quarters.
Okay.
But here's the kicker. The adjusted diluted EPS guidance is $0.75 to $0.35 to 85 cents.
75 to 85 cents.
Yeah. And analysts immediately jumped on that. It could be more than 40% below what the consensus was expecting before this call.
Wow. Okay, that explains a lot of the market reaction right there. A huge downward revision on EPS.
It's a stark revision, absolutely.
And we should also mention the acquisition obviously impacted the balance sheet. Debt's up to around $5.1 billion. Shares outstanding increased to 580 million.
Right. But management was very clear. They reaffirmed their commitment to get net leverage back down to at or below 2 times within 2 full years after the deal closed.
So deleveraging is a priority. What else are they focusing on with their capital?
Their priorities are pretty standard, but clear. Number 1, organic growth. Number 2, debt reduction. Number 3, returning capital to shareholders.
In that order.
That's the order they presented. They also mentioned they might consider small, tuck-in acquisitions, specifically for AZK's railing business or maybe recycling capabilities.
Interesting. So focus on the balance sheet, but still looking for small ways to enhance the AZEK portfolio.
Exactly. Shows a balance. Caution, but also ambition.
So given these headwinds, the integration work, what immediate actions is management taking, and what's the longer-term vision they're trying to sell?
Okay, immediate actions. They're focused on protecting that price and mix we talked about, driving cost savings through their internal program, the Hardie Operating System, or HOS.
Right, their efficiency system.
Yeah, lean manufacturing, continuous improvement, that kind of thing. And finishing key capacity expansions in Prattville, Alabama, and Oreo, Spain.
And on the cost side, beyond the synergies.
They're accelerating those AZK cost synergies, as I mentioned. And they use this interesting phrase, pedaling and clutching on expenditures.
Pedaling and clutching, like driving stick.
Kind of, yeah. I take it to mean they're being very selective, speeding up spending where needed, but hitting the clutch and slowing down elsewhere based on real-time conditions. Very dynamic cost management. Plus, Ed can't freeze.
Okay, actively managing costs. What about the big picture, the long-term story?
That really centers on material conversion. It's their core long-term thesis.
Meaning getting people to switch to their products.
Exactly. Shifting market share away from traditional stuff like wood siding, brick, stucco, even traditional wood decking, towards James Hardie's fiber cement and AZEK's premium low-maintenance composite and PVC products.
So convincing builders and homeowners that engineered materials are just better.
Better performance, lower maintenance, maybe more sustainable in some cases. That's the pitch.
And new products play into this.
For sure. They mention things like the Hardie architectural panel, specifically designed to compete against brick and stucco, and continuing to push their Color Plus pre-finished siding.
But it sounds like the benefits from these newer initiatives might be pushed out a bit.
That's a key point.
Yeah.
They now expect these things to provide more significant benefits in fiscal 27 and beyond, rather than in the back half of this fiscal year, FY26, as they might have initially hoped.
Okay, so a slight delay in realizing some of that growth potential. That also feeds into the revised guidance.
Precisely.
Oh.
And they also appointed Ryan Kilcullen as the new Chief Operations Officer to drive efficiency across the whole, now much larger, network.
Makes sense. And just a note for you tracking the company. Starting next quarter, Q2 FY26, they'll report under 4 new segments.
Right, it'll be.
Yeah.
Siding and trim, deck rail accessories, ANZ, that's Australia and New Zealand, and Europe. Should give us much better visibility into the combined business.
Definitely something to watch for. Okay, let's talk investor impact. Because, wow, the market reaction was immediate and, frankly, brutal.
Brutal is the word. The stock price plunged 34.4% the day after the call. Went from about $28.43 down to $18.64.
34% in a day.
And it wasn't just a quiet drop. Trading volume exploded. 10 times the average. 71.1 million shares changed hands.
Incredible volume. And options activity.
Also dramatic, particularly September $25 puts. Huge increase in activity there, signaling really strong bearish bets against the stock.
So the market's message was loud and clear. Negative.
Undeniably negative. It shows investors were laser focused on those big misses against consensus and that sharp downward revision to the FY26 guidance.
And the positive story around AZEK, the synergies, the long-term vision that just got drowned out.
Largely overshadowed. Yeah. The normalization of channel inventories, the softer demand, especially in the U.S. South, that seemed to catch analysts by surprise, led to widespread price target cuts.
So pulling this all together for you, the listener, what's the key takeaway here?
I think it's a really clear disconnect. You have management emphasizing this strong long-term vision built on material conversion and the AZEK synergies.
Right, the growth story.
While the market slammed the brakes, focusing squarely on the near-term pain, the demand reset, the higher interest costs from the deal, and the risk of more channel destocking. Just deep caution.
Yeah. And that upcoming Q2 earnings report with the new segments becomes absolutely crucial, doesn't it? To get clarity on how the combined company is actually performing and if those synergies are materializing as quickly as they say.
Totally. It really highlights that tension, that push and pull between a company's big strategic bets and the immediate, often unforgiving pressures of the market cycle.
Understanding that tension is really key here. Weighing the long view against today's reality.
Couldn't agree more.
Okay, we have covered a lot of ground. Now let's shift gears slightly for our This Is Not Financial Advice segment.
Ah, yes, the fun part.
Remember, this is purely for entertainment, sparking some ideas. Always, always do your own thorough research before making any investment decision.
Absolutely. Standard disclaimer applies. So, given that market reaction, we just talked about the immediate, sharp, incredibly negative plunge.
Down 34.4% on 10x volume.
Right. And those September $25 puts surging from like 47 cents to $5.50. I mean, that's fear right there.
Definitely looks like fear.
So a contrarian viewpoint might see an opening for an, let's call it, outrageous but plausible idea.
Okay, I'm intrigued. Outrageous but plausible.
Well, the consensus is clearly bearish, right?
Yeah.
But sometimes a sell-off that dramatic signals an overreaction. Panic selling, maybe?
So you're thinking buy the dip.
Not necessarily buying the stock outright, but maybe something like a bull put spread.
Okay, explain that.
It's an option strategy. An aggressive investor might consider selling a near-term, out-of-the-money put option. Say a September put with a strike price well below where the stock is trading now, maybe $15.
Selling a $15 put when the stock's maybe around $18 or $19.
Exactly. And at the same time, you'd buy a further out-of-the-money put, say a September $10 put, for protection, just in case things go really wrong.
So you collect a premium for selling the $15 put, hoping the stock stays above $15.
That's the core idea. You're capitalizing on that elevated implied volatility, the fear premium baked into option prices right now. You aim to profit if the stock stabilizes or even just drifts sideways or rebounds slightly. If it stays above $15 by expiration, the put you sold expires worthless, and you keep the net premium you collected. It's basically a bet that the market has excessively discounted the long-term value here.
The value from AZK, the material conversion story, the deleveraging promise.
Right. All the things management thinks will pay off more in FY27 and beyond. So you're essentially selling insurance against a further collapse that you believe is unlikely, capturing premium fueled by the market's fear.
It's definitely aggressive, a bet against that overwhelming bearish sentiment.
Highly aggressive, yes. And definitely not for everyone.
Yeah.
But, plausible if you believe the sell-off is overdone.
That certainly gives us something to think about. Okay, let's recap the whole picture. James Hardie's Q1 FY26, undoubtedly a challenging quarter. Significant misses against expectations, leading to that strong negative market reaction.
Yep. Primary drivers were that softer demand in R&R and new construction, plus that critical normalization of channel inventories, the destocking effect.
However, the strategic integration of AZEK does seem to be progressing. We heard about early cost and commercial synergy wins, affirming management's long-term vision around material conversion and just having a much bigger market to play in.
That's the bull case, yeah. But the updated FY26 guidance clearly reflects a more cautious near-term outlook. Benefits from some new initiatives seem pushed further out, more into FY27 and beyond.
So the critical task for management now is pretty clear. Prove that their operational chops and strategic growth plans can actually overcome these macroeconomic headwinds and deliver on those synergy promises.
Execution is everything from here on out.
This was our deep dive into James Hardie's Q1 FY26 earnings. We really hope this has helped equip you with a clear understanding of the company's performance and its current outlook.
As always, we encourage you to do your own research, dig deeper yourself.
Absolutely. And maybe think about what stood out most to you in this report, or perhaps the market's reaction to it, something to chew on.